All right. We are live and excited for everyone to join us. We'll give folks a couple of minutes to trickle in and join, but in the meantime, let us know where you're joining from and also post any questions you have on the topic. If you have them now, we won't address them now, but it'll help us. We'll make sure to incorporate it into the presentation as well. And I'll share, I'm joining from New Jersey. LA, Austin. And if you don't have questions yet, don't worry. I promise you'll have questions about Intentionally Defective Grantor Trusts by the end of these. These are one of the more powerful, but also kind of nuanced trust and estate planning structures. Is that a good way to describe it, Peter?
Yeah, I think that's a good way of putting it.
Nuanced or complicated? I'm curious as which is the better.
I think it's actually not that complicated. I think operationally they're pretty simple. I think some of the nuances are a little
complicated.
Are for people to understand sometimes.
Yeah. We'll give people another minute and then we'll get started. And if you're joining, let us know where you're joining from, and also feel free to put in any questions you have. We'll make sure to incorporate those during the presentation. You can also obviously hold the questions, and hopefully we'll actually proactively address them during this presentation. So we're going to get started now, and I just want to thank everyone for joining. We know it's busy weeks for everybody. So starting off, today we're going to be talking about intentionally defective grantor trusts. And the name is a little bit confusing in some sense of you may be wondering why would you want to use a defective product, but these are one of those powerful tools for families who are trying to minimize their estate taxes and over their lifetime gift exemption to pass on assets to future generations, preserve flexibility, and minimize their estate taxes. So, and just as a kind of quick overview on ourselves, Peter and I are from the Valur team, and Valur really helps people. The idea is to help people better understand and identify what are tax saving opportunities out there, whether it's addressing ordinary income taxes, capital gains, or estate taxes. In this webinar, we'll really be addressing, obviously, intentionally defective grantor trust, which is a tool to minimize estate taxes. So we'll really be focused on gift and estate taxes today. And kind of to finish off the piece on Valur, we help people understand these and identify structures that make sense for them. We have tools like calculators to help you understand the ROI of these structures. If you're just trying to even figure out what structure it is, we have a tool called the Guided Planner, which helps you identify structures that people typically use in your situation, as well as the ROI and the trade-offs. And then we help people set up these structures at no cost, and we do the administration at typically a fraction of the cost of a typical trust company. I founded the company based on my own experience going through this and just kind of seeing how slow, expensive, and opaque the space was. And really is how do we make this more accessible and optimized for individuals? Peter, do you mind giving kind of your quick background?
Yeah, my background is I'm a trust and estates attorney, tax attorney. I worked at large law firms for years, and I joined Valur this year in March. And I'm sort of helping build out a lot of the estate tax side of the business.
Yeah. And yes, and so Peter's kind of is the expert on these structures. And so we'll be able to kind of dive deep into kind of the nuances. One piece to call out is we do have, we're starting to do these webinars on a weekly basis. So also let us know if there's topics or particular focus areas that you want to learn more about, as we're going to be doing these more frequently and really want to make sure that they're kind of oriented towards the topics that you are interested in. So today's webinar, we're going to be talking about what is, as a basic level, what is the gift and estate tax exemption and important changes that are coming up. The reason we're going to really focus on that is that's what really drives the use and need for an intentionally defective grantor trust. If you're not worried about gift or estate taxes, it probably doesn't make sense for you. Then we'll go into what is an intentionally defective grantor trust, what are the key benefits and trade-offs, and then a case study to help really illustrate the value. And we'll save time for Q&A at the end, but we're hoping to also answer any questions that come up during the webinar as well. So let us know in the comments if you have any questions. So let's get started. Peter, maybe give kind of just a brief overview of what is the gift and estate tax.
Yeah, so the gift and estate tax is really a unified tax system that applies to people, higher net worth people who make transfers during their lifetimes or at death. So if you make a transfer to your kids, all else equal, let's say you transfer $1 million to your kids, that would be subject to a 40% estate tax. So a $400,000 gift tax. Depending on whether you're dead or alive, it's either gift tax or estate tax. If you're alive, it's a gift tax. If you die, it becomes estate tax. But let's say you're alive.
And just to hit on that one more time, these are really kind of the same thing. You have the same exemption
really
amount.
Unified tax system.
That's when he says unified tax. It means they use the same exemption amount, and really all that changes is when you die, it goes from being the gift tax or the gift exemption you have to when you pass away, it's the estate tax. So it's the same thing. Just really, are you alive or not?
Right. So all else equal, if you transferred $1 million to your kids, that would be a $1 million gift. It would be a 40% tax, so $400,000 tax, the federal level. Depending on what state you lived in, there might be state tax as well. So if you die in a state that has its own estate tax, like New York, you can have another up to 12% effective rate on top of the 40%. So, for example, Washington State has a 20% state estate tax. After accounting for deductions, it ends up being an additional 12%. So, if you die in Washington State, you can wind up paying essentially a 52%, combined federal and state estate tax. So it's a pretty hefty tax. The good news is you get a couple exemptions. The biggest, sort of most significant one is it's called the lifetime exemption, which is currently a $13.61 million exemption, which you can use throughout your lifetime. And each time you make a gift that uses some of that exemption, your remaining exemption amount goes down by the amount of the gift. So if you made, so right now the exemption is $13.61 million. So if you made $11 million of gifts during your lifetime, then when you died, you'd have $2.61 million of estate tax exemption left over, which your family could apply towards your estate tax liability. So one of the big
and just to double click, really what this means is you have a limited amount of valued assets that you can gift during your life or from your estate when you pass away. Before this estate tax doesn't start if Peter gives me $1 today, he doesn't owe gift taxes on that. There's a certain amount he can give away before that comes into effect.
Yeah. So if you look at the estate tax scenarios area at the bottom of the screen, it sort of shows you in practice what this means. So a single individual with a $14.61 million estate will owe $400,000 of estate tax because they'll have, they'll subtract out $13.61 million of lifetime exemption, leaving them $1 million over the threshold, which means that $1 million will be subject to a 40% tax. Someone with $23.61 million estate would owe $4 million of estate tax, or their heirs would owe $4 million of estate tax. and someone with $63 million would owe about $20 million of estate tax. Now the important thing here to point out is that the exemption amount is going down in a little over a year under current law, unless Congress acts before then.
December 31st, 2025 is the last day of the current exemption. And then January 1st, it's not only a new year, you have a lot less gift or estate tax exemption to deal with.
Right? Yeah, it's being cut in half under current law. So basically, it's reverting to what it would have been without the 2017 tax cut law. So unless Congress decides to extend the current law past 2025, it's going to be cut in half. And so right now, what a lot of people are doing are trying to use up their full 2024 exemption amount before it's cut in half in a little over a year.
Yeah, and what this practically means is a lot more people are going to face the gift and estate tax, because before, so each individual had roughly $14 million before they faced this gift and estate tax, and as a couple that meant 28. Now each of those numbers is getting cut in half. So not only that means there's more people, because obviously there's more people with $10 million of assets versus $20 million, but it also means those people that were facing the gift and estate tax before are facing a higher gift and estate tax than earlier, which means that estate planning for tax reasons becomes even more critical. And this is where it's, in these estate tax scenarios, we're talking about if you have a $23 million estate, you owe $4 million of estate taxes now if you give it away. By the way, everyone on this call and anyone who has these types of assets, generally your assets grow over time, right? You didn't typically build wealth by not being productive with capital or creating a business or investing. And so the key piece is that's $4 million now, but if you don't do estate planning now and your assets grow, that estate tax number is going to grow even larger. But on the other hand, if you do smart estate planning, you can not only move those assets outside of your estate and minimize estate taxes, but pass on more principal for your kids or future heirs. And because of compounding, every dollar that you save in taxes is going to be worth more than a dollar to your kids or future beneficiaries. And that's a really important concept. One is obviously compounding is a part of anything in finance, but these are really high, at the federal level, starting at 40%. And as Peter mentioned, some states have their own estate taxes. So you can be losing half of each dollar above this amount. And with compounding, it ends up being a really significant and, really impactful amount of money that you can pass on with proper estate planning. And this is one of those, if you don't understand what the kind of the value of this is, we do have today, we have some calculators on our site that can help you calculate this. We're actually rolling out in the next month more comprehensive calculators that can help you kind of look between different scenarios to see how much you would, or your heirs would benefit, or your clients would benefit from using these structures versus not using it, and even compare between the value of these structures. So, and that's the link there. But this is kind of just an important thing for everyone to really understand, is what is the gift and estate tax, because that's the reason you'd use these estate planning structures. So now let's go to what are intentionally defective grantor trusts. And just as kind of an acronym, they're also known as IDGTs, IDGT, because it's obviously kind of a long word to keep on saying. So Peter, maybe you want to jump into what are they? Yeah. Or what is, let's start with the basics of what are grantor and non-grantor trusts.
Yeah, so an IDGT is a type of grantor trust. It's worth sort of explaining what grantor trusts are before we get further into IDGTs. So a grantor trust is basically a trust that's ignored for income tax purposes. It's treated like the taxpayer themselves. So it's kind of like a single member LLC. You report it on your own 1040. Sometimes they file their own very short 1041 tax returns, but basically they're totally ignored for income tax purposes. And so if the grantor trust has income, it's reporting its income on your return. An example, there's a lot of grantor trusts that you probably encountered in your day to day. If you have a revocable living trust, it's definitely a grantor trust. So that's an example of a trust that's totally disregarded for income tax purposes. There's a bunch of other types of trusts that fall into this bucket, but the basic idea is a grantor trust is a type of trust that for income tax purposes is ignored.
The other example that I sometimes use in here is there's obviously revocable trust, which, really anyone who's looking at this type of estate tax planning should have a revocable trust. But there's also similar to a single member LLC, as while it's an entity that exists, it's really a flow through entity where the tax liability, the assets are still owned by you. Even if nominally the trust is on the ownership name, it all does flow through and sit on your tax return.
And then the non-grantor trust is sort of the alternative to the grantor trust. It's a non-grantor trust is a type of trust that is treated like a separate taxpayer for income tax purposes. So it's kind of the paradigmatic trust. It pays its own taxes. It gets deductions when it makes distributions to beneficiaries. And it could potentially be located in a state that is different than the state that the grantor lives in. So if you have a client in New York State, they could set up a trust in South Dakota, which doesn't have an income tax, and that trust could be a South Dakota taxpayer. But to do that, it has to be a non-grantor trust, because if it were a grantor trust, it would be based in the same state as the client for tax purposes.
Yeah, and one I think piece to call out here is that, from the IRS's point of view, these non-grantor trusts are effectively a taxpayer. It's like me or Peter. It has its own EIN. It files its own taxes. It has its own unique tax rate that is separate from yours. It has its own situs. So to what Peter's saying is, Peter lives in California, but if he had a non-grantor trust that he's a beneficiary of or the grantor of, that could be sitused or based in South Dakota and face South Dakota state taxes instead of California state taxes. And so, we won't get too deep into this, but one of the advantages is for people in high tax states, it is one way to arbitrage state tax rates. We'll get into that later, but this is really kind of more of those are the two contrasts. And now we'll explain, why would anyone want to make their grantor trust defective on purpose?
So an IDGT, the G in IDGT is grantor. So an IDGT is a type of grantor trust. So for income tax purposes, it's ignored. But unlike your revocable living trust, it's not ignored for gift and estate tax purposes. And so what happens is you make a gift to an IDGT. It's outside of your estate. So it's separate for gift and estate tax purposes, but it's still treated like a grantor trust for income tax purposes. So it's still reporting its income on your personal 1040. You're still paying the taxes on it. So it's sort of disregarded for income tax purposes, but not for other purposes. And the defect is referring to this sort of inconsistency between the rules for income tax purposes and the rules for gift and estate tax purposes. They never quite line up. And so this is a way of sort of trying to get the best of the income tax world while also getting the benefits of what's called a completed gift trust for gift and estate tax purposes.
And I think it's a really important piece to call out is what defines you as a grantor trust for income taxes and estate taxes are two different things. And essentially this trust is structured so that it is a grantor for income tax, but non-grantor for estate tax purposes. And the purpose behind this is to really kind of help you thread the needle to optimize estate tax planning. And we can kind of, we'll jump into why this is so powerful, but I think important context is, correct me if I'm wrong, Peter, IDGTs are the most popular estate tax planning structure that's used.
Yeah, it's. I mean, no one keeps numbers on this, but it's probably the most common estate tax vehicle out there. Super popular, very easy to maintain, and very flexible. So.
All right, let's maybe give this kind of overview of, we talked about kind of what's this key feature, but maybe we'll kind of go into why that's so powerful.
Yeah. So Actually, the next slide sort of goes into uh, why that's so powerful. But sort of briefly, because the trust is treated like you for income tax purposes, there's a bunch of stuff that you can do with it that can be very efficient from an estate tax perspective that would otherwise generate income tax liability if the trust were a separate taxpayer. And so there's just a bunch of neat features, which we'll talk about in the next slide.
Yeah, and we can kind of jump into that probably now.
Yeah.
I think probably the most salient point to call out here is the reason you use an IDGT versus a non-grantor trust. One of the most common distinctions is you're going to use both if you're over the lifetime gift exemption. But the more you are over the lifetime gift exemption, the more powerful an IDGT can be to minimizing estate taxes over time.
Yeah.
And this is where I'm sure everyone here knows who Mitt Romney is, knows he's a very sharp and well-resourced person. This is why it's like, again, we talked about it's probably the most commonly used trust structure for this. Mitt Romney used an IDGT for him and his family and his future heirs. And this is just, we're not going to go super deep into the details, but it's just a little bit of, this is what people do when they're trying to mitigate estate taxes and are significantly over the lifetime gift exemption or lifetime estate, or their estate exemption. So let's start with kind of like, why do people choose this and why it's so popular with these, and starting with kind of this most powerful benefit.
Yeah, so probably the biggest benefit over, the long term is that because the grantor trust is disregarded for income tax purposes, and the grantor is actually on the hook for its income taxes, the grantor can pay the trust income taxes without that being considered a gift for gift tax purposes. So let's say you make a $5 million gift to an IDGT. And so the trust has $5 million of assets. It's generating $400,000 a year of income, which is $200,000 a year of income tax liability. Rather than having the trust pay $200,000 of income tax, which would burn some of the value inside of the trust, you can actually pay the trust taxes for it. And since you're technically the taxpayer for income tax purposes, that's not a gift. You're just paying your taxes that you owe, but you're essentially transferring $200,000 to the trust because that's $200,000 of tax that the trust isn't paying. So you're getting $200,000 out of your estate and into the trust, which is outside of your estate. So that's a huge gift, and that's just year one. Over time, because the trust isn't paying its own taxes, you are. The trust is going to be able to compound at essentially pre-tax rates of return. And so, let's say you have an investment that's generating a 10% pre-tax return, 7% post-tax. The trust is actually going to be generating 10%, both pre and post-tax, since it's not paying its taxes, you're paying them. And so sort of because of the magic of compounding, over an extended period of time, the trust is going to grow much faster than your personal assets, which means that in 20 years, the trust is going to be enormous probably, and B, your annual income tax payments are going to become quite substantial. So let's say somebody had $10 million and they just put $1 million into an IDGT. The income tax liability in year one might not be that much, but by year 20, with the trust growing faster than the grantor's personal assets, is probably going to be a very large fraction, maybe a majority of the grantor's assets. And so at that point, those annual sort of tax gifts are going to be quite significant.
Yeah, and just to kind of add some numbers to this, right, is to make numbers simple. Let's say your assets are growing at 10% a year. One, hopefully everyone here understands the value of compounding. If your assets are growing at 10% a year, they'll roughly double every 7 years. So let's say you have $10 million in this trust and it's growing 10% a year. So it's growing $1 million. And let's say you generate a full tax liability. You sell all of that and it's long-term capital gains. So it's a $350,000 tax liability for that 1 year. Now, let's say you're out of your lifetime gift exemption. You paying that tax means personally paying the tax on the trust income means the trust doesn't have to lose $350,000. So it can invest that $350,000. Now, that means one, it's growing at its pure growth, right? It's not losing taxes and it's getting the compound growth on what would have been lost tax money. But then it also means that your estate, not only are you paying the taxes on your own income and your own realized capital gains, but you're slowing the growth of it because you're paying someone else's, in this case, the trust's taxes. And this is why the agent really makes sense for individuals who are, fairly well over the estate tax exemption, is because if you don't lower the size of your estate and you've used up your lifetime gift exemption, you're going to lose at least 40% of that delta over the lifetime gift exemption to estate taxes. So part of your goal is get assets out of your estate, have those grow as quickly as possible, but it's also ensure that your personal estate doesn't keep growing faster because you're going to lose at least 40% of that growth. And so this is where the power of have those assets grow faster outside of your estate, essentially tax exempt, and then you slow the growth of your own estate so you ensure that when you pass away that it's not mostly lost to estate taxes. And this is probably the most powerful benefit of IDGTs. And this in combination with kind of one of the next things we talk about, we've kind of worked out the math and we have calculators and things like that we can illustrate this with, is someone who has $1 billion and hasn't done estate planning, in a decade, they can really move all of those assets outside of their estate, with the proper kind of, market environment so that they can completely avoid estate taxes in a decade. And it's hard to really understand this, but these indirect gifts and paying off the taxes is an incredibly powerful estate tax mitigation tool.
Yeah. So then there's this tax-free transactions bucket, which Monty referred to a little bit. So that's sort of a grab bag of things. This is all stuff that you can do with the trust that doesn't generate income tax liability because it's a disregarded taxpayer for income tax purposes. So there's a bunch of stuff. So one thing you can do is you can swap assets with the trust. So let's say the trust has a $2 million asset that you would like to get back into your own name for whatever reason. There's a bunch of reasons why that might make sense. And you had $2 million of cash in your own name. You could swap the appreciated asset inside of the trust, get that back from the trust, give the trust $2 million of something else like cash or whatever. And then that's not treated like any sort of realization event. So you wouldn't have recognized any gain. There's no income tax consequences from swapping assets out of the trust. Also, no gift tax consequences, assuming that you transfer an asset that has an equal value to the thing that you're transferring out. So really flexible structure. Another thing that you can do is you can loan money to a trust or borrow money from the trust. So let's say you have some kind of liquidity need and the trust has $1 million of cash. You can borrow that $1 million of cash at the applicable federal rate, which right now is around 3 or 4%. You can pay back the trust at some future date when you have liquidity to pay it back. And then you can also loan the trust money. Why would you loan money to a trust? Essentially because the interest rates, the applicable federal rates, are generally lower than most investment returns, and so you can sort of capitalize on the spread between the government interest rate and the investment return. So let's say you have an investment that you think is going to generate 10% annual returns. If you can loan the trust money and the trust only has to pay, let's say, 3% interest each year, then it'll basically be able to capture the 7% spread between the 3% interest rate and the 10% returns. It'll be able to capture that spread. And so at the end of the 9-year loan, whatever it is, you'll have transferred a ton of value to the trust just by letting it keep that sort of investment return.
Yeah, so and just to kind of really hit this home, so this is kind of in conjunction with what I was saying is this is how someone who's worth $1 billion inside their estate and can in a decade get all of that, essentially those assets outside. So one is you transfer these assets to the trust. As the assets in the IDGT grow, you pay the taxes on it. So one, you have an additional cost on your side and the trust grows tax free. And then you can cap this on top of it of swapping, or if you loan money to the trust, what that means is, and kind of another side of this is, you're able to effectively capture this arbitrage. Now, again, generally, folks who are facing estate taxes are on average better at investing and growing their assets, right, than the kind of average person. And so if you're able to say, hey, my personal estate, I'm capping it at 4% growth. So that means your estate is only going to go at the top line 4%. But then you loan it to your trust, and your trust, let's say, invested in, let's say stock market's growing 9%, private equity is growing 14%. Let's say you invested in alternatives and you're growing at 14% a year. So now there's this 10% arbitrage that the trust is growing on loaned money. And then on top of that, because this is an intentionally defective trust, you are personally paying the taxes on the income that the trust is generating on your loan. So there's this kind of combination where you cap your personal growth, then the trust is able to hopefully arbitrage and invest those assets and grow faster than this interest rate of, let's say, 4%. But then because you pay taxes on that 4% that you're earning from the trust is really significantly less than that between taxes. And this is as the trust grows faster and faster and has more assets, you're actually typically reducing the size of your estate. And there's kind of a couple questions here. This is specific to the loans.
You want to address those? These, I'll address these real quick. So Sahil's question, is the interest taxable to the IDGT or the grantor, given that they're both reported in the same personal tax return? And Sahil sort of hints at this. So remember, the grantor trust is treated like the grantor for income tax purposes, and so from the IRS's perspective, it's not like a real loan. It's like you're loaning money to yourself, and so even though you have to pay interest for gift and estate tax purposes, that interest is non-taxable. So you're not paying any tax. Nobody's paying tax on the interest, and so that the interest isn't reported anywhere because it's not taxable interest. And this also goes to Stephen's question. So the answer is you don't report that anywhere. It's not taxable interest. And then Stephen's question is on the loan, is the interest taxable to the grantor? And is it deductible to the trust, which lowers the tax the grantor pays? And the grantor just doesn't, there's no taxable interest. It's not taxable to anybody. There's no deduction because there's no tax to deduct.
Yeah. And again, this is kind of it's really this unique thing where you can take the fact that income tax and estate tax purposes have two different sets of grantor rules.
Yeah.
You're able to thread the needle to be a grantor on one and not on the other. And whether this is interest-free loans or, or swapping assets. And by the way, I might have missed this. What's the typical limit on how much you can loan to the trust, Peter?
Yeah. So, there aren't formal limits. There are kind of rules of thumb. So most people would say that you don't want to lend more than about 9 times the value of the assets in the trust. So if the trust has $1 million,
again, that's nine times the value of the assets in the trust.
Yeah. So if the trust has $1 million, the rule of thumb that estate planners use is you shouldn't lend it more than $9 million. On the theory that a bank would never lend you much more than 9 times capitalization. But that's sort of a rule of thumb. You can actually lend more than that as long as you get some sort of third-party guarantee. So like if you had $1 million in a trust and you wanted to lend $20 million to it, you could do that. To be safe, you'd want to get some kind of guarantor to guarantee the loan.
Yeah. And we're going to keep on hammering this because of how powerful this is. Aaron asked, what is the IDGT's contribution? So what is the limitation on how much you can contribute to the IDGT?
There's no real limit. In practice, people don't want to give more than their lifetime exemption amount, because beyond that, they'd have to pay gift tax. Some people actually do give more than their lifetime exemption amount. Then they just pay gift tax on the transfer. But sort of in practice, people would typically give up to their lifetime exemption amount. And then in order to transfer amounts beyond that, they use these sort of tools like loans and stuff that help them sort of transfer more value into the trust without using any exemption.
Yeah, and just to give kind of an idea of so let's say you transfer 10, let's say we're kind of in between this world where right now you can transfer 14 million with gift and estate tax free, and it'll be 7 million in a little over a year. Let's say you transfer $10 million to the trust. You could then, if the trust has 10 million, and let's say you have $90 million, you could then theoretically loan your remaining $90 million inside your estate to the trust at a 4% interest rate. And so now all of a sudden, let's say that the trust has $100 million it's investing, and it grows that at 10%, keeping numbers simple so I can kind of make this easy to follow. Invest $100 million at 10%. So that's $10 million in growth. And let's say it realizes all of that. Now, that's $10 million in growth, let's say 35% tax rate, that's $3.5 million in taxes. Now, let's kind of go back to, you loan the trust $90 million at a 4% interest rate. That's roughly going to be $3.6 million in interest that the trust owes you, just using simple kind of loan and math there. So this is where that entire loan is essentially being paid off on the taxes you owe. And so this is how you can pretty quickly reduce the size of your estate, because now your estate's not growing. Even with that 4% interest, it's staying static. But then every single year, the trust investments, again, assuming you're investing well and the assets go up, you're actually increasing the value of the trust assets because it's growing faster than that loan rate. And you're what's called burning down your estate. Well, just in the interest of time, really, it's kind of just, it's such a powerful tool. We can't state it enough of the tax benefits of IDGTs when you're over the lifetime gift and estate tax exemption, and you want to minimize those taxes. But maybe let's jump to kind of what are some of the non-tax benefits and trade-offs here. Oh, Peter, I think you're on mute.
Sorry, I was muted. Yeah. So the big non-tax benefits are asset protection. This is true of other trusts too, but assets inside of an IDGT are not reachable by your creditors generally, or by your beneficiaries' creditors. That's also true of non-grantor trusts, but it's a big benefit of setting up trusts in general. You retain indirect access. So with an IDGT, you can borrow from the trust. So let's say you need liquidity for whatever reason, you need $1 million of cash. If the trust has $1 million of cash, it can loan you the money. That interest won't be taxable, and then you can pay it back when you have more liquidity. And so that's kind of a nice feature for people. And then indirect control is referring to, if you give someone assets outright, as soon as you transfer the asset, you're basically surrendering all sort of control over the assets. If you set up a trust, whether an IDGT or some other type of trust, you retain some amount of control over those assets. You could have rules in the trust about distributions. You could name your friend as trustee to make distribution decisions, and so you're sort of retaining some form of control, even though you're probably not going to be the trustee yourself. You're retaining some sort of control over the trust that you wouldn't have if you just made an outright gift.
Yeah, and this is, by the way, there's obviously asset protection, this indirect control. I do think of one of these things is, people are always worried about, this goes to the trade-offs. This is an irrevocable trust. You're giving away assets. People often worry about, how do I make sure I have enough for me, my spouse's kind of welfare and livelihood, and not being able to take, again, these loans aren't at typically commercial terms. They're at what's called the IRS's interest rates, which tend to be lower. You're able to have people tend to find that as a comforting feature that they can access these, have this indirect access and provide liquidity in the event they do need it.
Yeah, and so the IRS interest rates, which are called applicable federal rates, are tied to Treasury yields. So there's 3 different interest rates without going too deep into it. It's basically, depending on the term, it's either the 1 to 2 year yield, the 7-year yield, or the 20-year yield. So right now, the 1 to 2 year is like 4.5% or something. The 7-year is about 3.6. It's going to be 3.6. And
Yeah, I think the short moral of the story is these.
Yeah.
First of all, we're at pretty high
Basically, it's
interest rates.
something. Yeah.
Yeah, it's typically, when I was using 4% as a loan rate, that's probably pretty high. Historically, it's in the
Yeah.
3% range. Maybe
Yeah,
let's jump into kind of like,
Yeah, and as the Federal Reserve cuts interest rates, it'll settle around 3%.
yeah, let's jump into kind of what are the downsides or trade-offs with this structure.
So one is what you mentioned. These trusts are irrevocable. You can borrow some of the money back as a loan, but you can't just you can't just take back the money and say never mind in a year, 2 years from now. So you are making a gift to a trust, even if it's a flexible trust.
By the way, that being said, you don't have to gift all your assets at once. And the most common approach is people will start gifting some portion of their assets or a particular type of asset, and they'll gift more over time. So it isn't a all or nothing. It tends to be an incremental, gradual process.
Yeah. And then, so, we mentioned other types of trusts, like non-grantor trusts that have state income tax savings. It just don't save state income tax. They don't save state tax in general. Or they don't really save income tax in general. They're really a gift and estate tax saving vehicle. Very efficient from a gift and estate tax perspective. Not really saving state or federal income tax overall. So, if you really wanted to save New York income tax, a non-grantor trust might make sense because you could set up a non-grantor trust in South Dakota or something like that. And it's not going to save you New York income tax. If you're a New York taxpayer, the trust is also a New York taxpayer.
Yeah, and that's kind of a great transition. I think one thing to talk about is like, what is it? I think one is, you always want to know, whether it's you or your client, what problem are you solving? And to kind of what Peter's saying is, are you focused on avoiding income tax planning, which is maybe state taxes, or estate tax planning and focus on estate taxes? And this is really kind of depending on which path or which problem you're solving. That's where you get to kind of, am I using the non-grantor trust for this or the IDGT? So, but maybe we'll jump into, we've kind of tried to hammer home some of what are the value of an IDGT. And so maybe Peter, want to kind of talk through, here's kind of a case study with just numbers and.
Yeah, this is a case study. So the basic idea is that over a long period of time, you save a ton of money with an IDGT and with a lot of trust structures actually, but with an IDGT in particular. And so this is showing someone named Jay, 41, unmarried, has $15 million. So this assumes he's generating 9% returns each year for the next 50 years. And it assumes that he makes a $7 million gift. And then maybe loans $5 million from his personal assets to the trust. And so as you can see, over 50 years, you're basically saving your children, you're basically doubling the amount of money they get. So you're basically wiping out almost all of the estate tax liability that they would otherwise pay in this example. And it's not like a weird example that we crafted in order to generate really high returns. There's a lot of different examples that would be pretty similar. But the basic idea is that, if you gift $7 million to a trust and you pay the trust taxes, it's just going to generate, you're just going to shift it like a huge fraction of your wealth, probably the vast majority, out of your taxable estate, the part of your estate that's subject to estate tax, and into the trust, which is outside of your taxable estate. So it's not going to be subject to estate tax. And so because in the in the sort of green and black bars, your kids are basically paying little, if any, estate tax. They're just coming out way ahead versus the no gift scenario where your kids are essentially paying a 50% estate tax. This assumes a New York resident, and so his estate tax rate is around 50%.
Yeah, and again, this is just really one is the power. Not doing any estate tax planning, you're passing on the least amount. It's obviously still a lot of money because of compounding and growth and time here. But with an digital loan, you're dramatically increasing this. And then the loan further optimizes this. And by the way, this is, if you notice in the scenario, this IDGT plus loan is obviously better than the IDGT alone. If in kind of this scenario, the individual had more assets and could do a higher loan amount or more leverage, the numbers would be dramatically higher. And so one of the things to call out is in a world where, currently you can gift 14 million, a little under 14 with the current numbers during your lifetime individually. But as this gift exemption drops at the end of 2025, using leverage in this loans will be even more powerful for individuals who have a lot of value because, as a couple, they could give 28 million today. That's going to drop to 14. And so the power of leverage and loans to move those outside of your state will become even more critical and important to understand and utilize. Yeah. So we'll kind of jump into, and I know there's a couple questions. I think some of this will tie into this next slide here. But what I was going to say is, and correct me if I'm wrong, really the ideal client is someone who's going to be over the 2026 exemption amount of $7 million.
Yeah.
If they're married, it's 14 million. Now, that number, let's say they've already used up their lifetime gift exemption amount, then that number may be smaller. This actually goes to a question that Aaron brought up. So today the number is a little under 14 million. What that means is today I could gift $14 million to an IDGT, right? And use up a little under and use up my entire exemption amount, right? And then the IDGT can keep on growing. But that doesn't mean I won't be penalized in 2 years or a year and a half when that exemption amount drops. Correct, Peter?
Yeah. So there's IRS guidance on this, and basically what the IRS has said is that there's no clawback. So if you use your exemption when your exemption is 14 million, and you make a 13 or 14 million dollar gift, they're not going to come back, 2 years from now and say, oh, the exemption is 7 million, you've used 14 million, so you're over the exemption. So there's no clawback. You can lock in exemption now by using the current exemption amount, and the IRS isn't going to come back. The only implication is that if you use your entire $14 million exemption and then the exemption goes down to 7 million in 2 years, that just means you won't have any exemption left over.
It doesn't reset. You don't get another 7 million.
Yeah, you don't get another 7 million.
And this is when the loan piece is, if you still have assets, you're not going to gift directly to the trust. You're going to gift at a 3% interest rate loan to the trust, and then it'll invest it. And kind of next, some of these other questions here. First of all, you can schedule time with us if you have questions about this. We'll also have, again, these calculators that we've mentioned. They're all free to access. You can also, a benefit of our site is you can set up these trusts in less than 24 hours at no cost. We only charge for administration, and that's fairly low fee compared to typical companies. We do base our IDGTs if you want us or our partners to be trustees in South Dakota. And part of this goes to Sahil's question as to how long can an IDGT last? It is tied to each states have a different rule. And part of the reason, one of the many reasons we choose South Dakota is one is asset protection, but it's also there is no limitation on time period in South Dakota. So these things can literally last for forever. So it's not just your kids and grandkids, it's your grandkids, and just playing that out, that these assets can grow a state and generation skipping tax free and create more wealth for your kind of heirs. Do you want to answer these? There's anything to add there, Peter?
Sahil has a bunch of sort of individual questions. So the perpetuity period, like you said, depends on the state. Does an IDGT need to be distributed upon a grantor's demise? No, it can keep lasting. It can last forever. Can the trustee distribute the entire IDGT to the beneficiary during the grantor's lifetime? Yes, if they want to. It's usually more efficient. to keep assets in trust for as long as possible, but you don't have to. And then Stephen had a question about the term of the promissory note. So he says, can you set any term on the loan, or is there a limit? For example, can you take out a loan for 50 years? The answer is you can set any term you want. So the only sort of limitation really is that there's different interest rates, different applicable federal rates for different terms. So the 50-year term would be the long-term rate. So it's a little bit higher interest rate usually, although right
but
now
marginally higher. Like we're talking, 0.4% higher typically. I think is.
Yeah, just it's the spread between the 7-year and the 20-year Treasury, basically, which usually isn't huge, but in general, most people borrow at the midterm AFR, so that means a 3 to 9 year term, so that they're able to sort of lock in a decently long term, but also have a little bit lower interest rate than they'd get with the long-term AFR. But you could do a super long-term loan if you wanted to.
Yeah, and so and this is where, by the way, it's you can use our tools kind of to help estimate and understand these numbers. I would one thing I'd say is kind of going to again, you can set up time to chat with us if you have any questions. Typically, we see the people that kind of like we work with or we help advisors work with is, and break it down. And this is very estate tax focused. So again, to this, you want people who will be over the 2026 estate tax exemption for an IDGT to make sense. But there's, if they're on the ordinary income side and they're earning more than, I'd say, $300,000 a year, or on the capital gain side, they have an asset that's worth more than $500,000 and appreciated 3x, then we could still see income tax planning things there. This estate tax side, where there's IDGTs or other structures, is they either have over 7 million or expect to be over 7 million. Because again, some of this is also being proactive and looking ahead. So they may not be there, but they may have assets they expect to appreciate, or they're just planning ahead. That's really when it makes sense to kind of look at. I'm going to add another question from TJ here. What is making the IDGT grow compounded interest rate? I guess I'll just answer this. They can invest in really almost anything, whether it's stock market, real estate, crypto, private equity, private credit. It's investing in anything a high net worth individual would invest in themselves.
Yeah, and actually, it's like slightly more tax efficient, all else equal, to invest in less income tax efficient investments. Yeah. So like private credit, for example, generates a lot of income tax liability. You shouldn't go out of your way to invest in private credit because of the trust.
But you should allocate those investments.
It makes sense to allocate sort of like, in general, higher return investments and investments that generate a lot of income tax liability are good fits for these sorts of trusts. Because let's say you have $1 million of private credit that's generating $100,000 of income tax liability each year. If that private credit's in the trust, basically you're able to pay the trust income taxes each year, which is like making a gift to the trust. Whereas if you had an index fund that wasn't really generating income tax liability, you wouldn't be able to capitalize on that that ability to pay the trust taxes.
Yeah, and I guess another way to frame that is the more you are over that lifetime gift exemption, you want to move or invest in less tax efficient things out of the IDGT. And this is, by the way, what Peter's saying is you don't want to choose to invest in these things because of their lack of tax efficiency. This is, let's say you want to allocate 10% of your net worth to private credit for diversification. You would allocate that investment coming from the IDGT because you're paying the tax liability on this. This allows that all of that private credit growth to take place outside of your estate and estate tax free, while reducing the size of your estate and future estate taxes that you owe. So it's this that's the real power of being intentionally defective. Looks like you pulled up a question from Brian here.
Yeah, so Brian has a question: what happens when the grantor dies? So it's a good question. So an IDGT could last for 1,000 years in theory, but it won't be an IDGT the entire time. It's only an IDGT as long as the grantor is alive. Once the grantor is dead, there's no grantor to pay the trust taxes, and so it ceases to be an IDGT. So let's say like your parents could set up an IDGT for you, and then when they died, it would cease to be an IDGT. But you could set up an IDGT for your children and sort of generate the same sort of tax savings for them. But yeah, the initial IDGT is eventually going to stop being an IDGT. It'll eventually turn into a non-grantor trust when the grantor dies. And you can, by the way, you can also turn off the grantor trust status before the grantor dies. So, but just by filling out a simple form, you can convert it from a grantor trust into a non-grantor trust. So it'll start paying its own taxes going forward if you wanted to.
Yeah, and this is there's a question here about how can beneficiaries be changed. Like, so the typical structure of, these are called, we were mentioning, Peter, we call it how long these trusts last.
Yeah.
Typically, so we base our trusts in South Dakota so that they can last for forever. Typically, the way that these are structured is all your future heirs. So as your great grandkid is born, they become an heir to this, and so you don't have to specifically add them; they are getting added. But I guess to frame this for you, Peter, is how much flexibility is there in changing beneficiaries?
So
what's the typical way to structure it?
So there's a lot of flexibility. So two things. So first of all, as Monty was mentioning, typically these trusts are drafted in very flexible, sort of open-ended ways. And so what tends to happen is there's a new trust automatically created at each generation. So if you create a trust for your children and your children die, you have an automatic trust created for the benefit of your grandchildren. So the trust splits on your kid's death, and if you had two grandchildren, it would split into two trusts for the grandchildren without having to create a new trust. It would just sort of happen automatically. If you wanted to add someone else, like a friend or something, as a beneficiary, you typically could pretty easily. The way Valur trusts work is there's an officer called a trust protector who you can name, and the trust protector has the power to appoint a sort of to add and remove beneficiaries in the future. So you could add, your friend as a beneficiary in the future, if that made sense.
Yeah, I know there's a lot of questions. So I'd say is like, and just to kind of in the interest of wrapping up here is, one is let us know if you have questions. And again, this is where it's for IDGTs, feel free to email us at Monty or peter@valur.io. Also, we have a lot of content on this stuff on our website. We also have calculators so you can help understand these things. You can also set up time directly with us. And again, IDGTs will typically make sense if you or your client has or expects to have more than $7 million inside their estate. But you can also talk to us if there's capital gains tax planning, where, again, it's likely going to be a $500,000 asset that's at least increased 3x. You're looking to defer those tax liabilities, or on the ordinary income side, if they have more than $300K in annual income. So really appreciate the time and all the great questions. And just as one last reminder, we're going to have webinars every week at this time. So also please let us know if there's other topics that you want to learn about. Thanks, everyone.